pops up, we'll go ahead and dive into this. So hopefully everybody's ready for a good holiday weekend here coming up. But I did want to make this my last training class for the year, and it's really important. So it's going to cover quite a bit of material. So, definitely make notes. I will record this, but it's really going to help you guys out in terms of understanding, what needs to happen when you guys put in a loan application, whether in lending pad or anywhere else. And this is why I called it application or imagination, sort of just a kind of funny play on words there. But a lot of people, put applications in, or they take an application in the system, don't really know or think about, hey, is this going to go anywhere and stuff. And you really need to, especially as a new loan officer, you got to hone into the protocols and really understand the entire application process. Number one, to protect yourself, because now you're dealing with a borrower, and you've got sort of a fiduciary obligation to the borrower in terms of the loan and the lending. And you also want to make sure that, you're not putting your reputation out there on something that, you're just crossing your fingers and hoping that, this application is going to go through, or somebody's going to walk it through for you, or make it work for you. So I wanted to really touch on this subject and go into quite a bit of depth with it, to help you guys get a better understanding of the process. Some of this might be redundant to some of you guys that know a lot about loans already, or you've been in the mortgage business for a while. But there is some new 2023 stuff in here as well, that you may not be aware of, or you may. So hopefully this is going to be helpful for everybody, and I'll try to sort of go slow enough to allow people to absorb the content as we go. So we all know the world's full of good and bad loans. We know what makes a good loan application. The answer is a good loan officer, right? For the loan officer to satisfy his duty to the borrower, they should ensure that the borrower is well qualified for the loan program they select. In order to do that, the loan officer must know how to take a loan application and how to ask the borrower the right questions. That's the first part of it. A lot of people send out their point of sale link and they think that's it. I'm just going to send this out. I'm going to let the borrower put in whatever they need to put in here, and then we'll just roll the dice and see where this loan is going to end up. And that's really not the right approach that you want to take as a loan officer to your loans. Every loan is money for you, right? So when you're taking an application, number one, you always have to put in your mind, I owe it to the borrower. I owe it to the person that I am doing the business with, number one, not to waste their time with something that, isn't going to go anywhere. You're basically trying to fit a, square peg in a round hole. But when you take the application, you're obligating yourself to the borrower as a lender. So you're basically saying, hey, I represent Obsidian Financial Services, and I am going to work to get you this loan. And like I said, there's a couple of factors you want to consider in that. Number one, your reputation as a loan officer. If you do a bad job, yeah, you lose a borrower, but you also lose a realtor. And that realtor may be somebody that was planning on giving you a lot of loans in the future, continuing to work with you. And, you only get one chance to impress them. The only time that they remember your loan is if it's a good loan. The first bad loan you have out of 20, then they're out the door and looking for another lender. Right. The other things that you want to take into consideration are the regulations. You have ECOA, which talks about equality and, making sure that you are not violating any of the equality-based regulations that are pertaining to a loan. So in other words, if you take an application and that application sits for 30 days, you don't follow up with the borrower and everything else, and you never mark that borrower, that loan is incomplete within that 30-day time frame, you are basically telling that borrower that, number one, either you don't care enough about them to follow up on their loan, or number two, that for whatever reason, you are discriminating against them because you're not doing anything to get their loan done. And ECOA is very, very strict in that regard. So putting loans in lending pad and just saying, the borrower's not contacting me, or I don't know what's going on with this loan. And then the 30 days passes and you've done nothing on the loan. If that person decides to come back and file a complaint against you, an ethics complaint or something, that's going to stick out because they're going to audit the system. They're going to see that loan sat in there, and that once you got that application in, you never touched it. So you have a legal obligation, a regulatory obligation as a loan officer to do something with that application once you take it. Okay, you can't just let it sit there and say, oh, it's a lead. All right, once they start filling that application out, that is considered an application. It's considered an incomplete application, but if the borrower did it, if the borrower initiated it, that means it's an application. All right, no matter what state it's in. You have to be ready to follow through and always think about what the next step is with your loan. All right. You should be looking at every one of your loans in your pipeline, because there's nobody at Obsidian that has like 20 or 30 loans going at once, where you don't have the time every day to look at each of your loans and say, what do I need to do next to move this to the next step? The LOS should not be the junkyard where loans go to die. All right. So in other words, you shouldn't just be taking applications, leaving them sitting in lending pad. This borrower is not serious, or this one's not. Whatever the situation is, that loan needs to be put in some type of a status, whether it's withdrawn, whether it's incomplete, whether it's denied, whatever is going on with that loan. If it's not moving, you need to go ahead and take ownership of that and make sure that you're putting that loan in the status. I'm going to tell you the reason why. If you look at this top line right here, these are what LendingPad uses to track TRID violations. All right, they're called TRID markers. So when you look at it, the stats here don't lie. Okay, we have 265 loans currently that are in your pipelines that are in a 3-day violation. All right. What the 3-day violation means is that you've got an application taken status, but you never sent an LE out. All right. The next one is the 10-day. All right. That's where a loan estimate went out, but there was never any intent to proceed. All right. And then you got your 30-day with 398 loans where nothing has happened during that 30-day period. There's no status of incomplete or anything else. These are the 3 things that you should be looking at in your pipeline when you're looking at your dashboard. If you're seeing any of those statuses in there, you need to go into your pipeline and correct that status on that loan. All right, because ultimately what happens is we get audited on these things annually, right? And so when they look in the system, they say, oh, look at this, 265 loans that aren't violating TRID. Let's go see whose loans those are, right? Danielle, give us a list of all of those loans, 10-day loans, et cetera, et cetera. So you don't want that to happen. You're obviously taking applications for a reason. Whether the borrower qualifies or doesn't qualify, that's, irrelevant at that point. I would say to a loan officer, the most important aspect of your interaction with a borrower is to get the facts. Get the facts first before you even decide, hey, am I going to move forward into the application stage with this person? All right. I tell everybody it's very easy to get a Zoom account set up or get a Ring Central account. They give them to you for free. You got 45 minutes, plenty of time to do an interview with the borrower and find out what they're about. Don't let the dog eat your homework when it comes to your application. Don't sit there and say, I'm not going to be diligent, or I'm going to leave everything on my LOA to do for me. I don't need to do anything. I don't need to be involved in my loan. The loan has your name on it. The documents that the borrower signed has your name on it. All right. The borrower is waiting on you. They're expecting you to be doing your job. You've convinced them that you're a professional, a good loan officer. You're going to do what it takes to get their loan done. So I want to talk about TRID and pre-approvals, because this is an area where a lot of people get tripped up. All right. So understanding what the pre-approval process is, what the requirements are from TRID in order to move your loan forward. And, like I was saying, we're looking at those 3-day and 10-day markers. So we have to understand what that's telling us and what our obligation as a loan officer is to do in order to stay compliant when that's happening. Okay. So first of all, what is TRID? All right. TRID is an acronym. Comes from two separate regulations. There was TILA and there was RESPA. Somebody decided to put those two together, right? It was put together. It's basically what they call the know before you go process. In other words, know what's coming at you before you decide if you want to move or become contractually obligated to the loan. All right, to the creditor. All right, if you want to learn more about it, great reading. If you're taking a bathroom break or whatever, take your tablet with you. Go on the CFPB website, consumerfinance.gov, and sit there and read about TRID. All right, because it's one of the most important things that you have to know. And it's really there to assist your borrower, but it also makes your life a little bit more miserable, right? Loans are timed transactions. So there's a timeline that has to be met. All right. And again, TRID deals with that. That's what it is. Timing of loan estimate and when you're going to disclose. All right. It is critical that the loan officer be cognizant of their responsibilities in honoring the timeline and assisting the LOA, processing and underwriting, and closing teams to ensure that the timing of their actions regarding the loan file does not violate the TRID guidelines. Okay, so you want to make sure that you are communicating with your LOA. It's super important that, if you're not going to be involved in your loan because you're a realtor, you got other things going on, that you are making that introduction to your borrower. All right. If you're doing a conference call with the borrower to do an interview or something like that, have your LOA on that call and say, hey, this is my LOA. They're going to be handling getting any other things that I need from you and stuff. Please communicate with them. Because a lot of times, if you're just sending out an email and you're putting the LOA on there in the email, they don't want to deal with the LOA unless you tell them that, this is a person that you trust to handle the transaction for you, right? So you have to make them aware of that. Don't just assume because you put them on the email that they're going to talk to your LOA. Borrowers are very antsy that way. The relationship is with the loan officer, not with the LOA. You have to establish that relationship by saying, hey, this is my right-hand man or woman right here. She's going to take care, or he's going to take care of this, and make sure that this loan moves. That's going to bridge that gap for them. So again, we talk about TRID requirements. All right. A lot of people, it's really simple. You need the consumer's name, consumer's income, consumer's social security number to obtain a credit report, property address, an estimate of the value of the property, and the mortgage loan amount that's being sought. Okay. Sounds simple, right? But again, how do you get those things? Right? If the consumer submits these 6 pieces of information, so let's say you ask them for this and they send you an email with these 6 things in there, rather than actually starting a physical application. If they send you those 6 things, the requirement to provide the loan estimate is triggered, and the creditor must ensure the loan estimate is delivered or placed in the mail within 3 business days, right? We don't run across that scenario at Obsidian very often or at all. And the reason why is because the definition of an application refers to the submission of the 6 pieces of information. But what TRID does say, if the consumer starts filling out a form online, enters the 6 pieces of information that constitute an application for the purposes of the TRID rule, but then save the form and don't complete it until a later time, the consumer has not submitted the 6 pieces of information. So there's a very clear distinction there, right, between how that gets to you. So normally a lot of people start panicking because as soon as they see that the borrower's put in the application and there's some information in there, they have not completed everything per TRID because they are doing a manual application, as opposed to actually providing those 6 pieces of information to you directly. It's the same thing with like credit. The reason that we send out the credit card off, as I've told a lot of people, is because until the application is completed and acknowledged, that it's signed, we cannot ask the borrower for credit. at that point in time, right? You have to have a complete application because the application implies consent to run their credit. But if you don't have that, you have to have something from the borrower authorizing you to run credit. I don't know how many loans I go into in lending pad where the loan officer has ran credit without getting any ID cards or any of the other additional information. All right. That's a no-no. You definitely don't want to ever do that. You don't know whose credit you're running. That just opens you up for fraud, right? So you don't ever want to do that. You want to make sure that, these are the main things that you are doing right off of the bat. All right. That way you're never going to violate TRID. Now, the other question people always ask me is, okay, well, this guy's a TBD, right? He's going to go out, he's going to shop. He's wanting to get an idea of what he's going to be able to purchase. If he's doing that, how is that going to violate TRID? Well, it's not, because, again, you have to remember that, let me go back here, that we have to have 6 pieces of information. One of those pieces of information is the property address. So if you have a TBD, you don't have a property address, that's not completing all 6 of the requirements. All right. And in order for a property address to really be considered a property address, it's really got to be, that there is a agreement, for the purchase to move forward. Right. Otherwise, it's more or less just like going on Zillow and pulling up an address and saying, oh, yeah, this is the property I want. Because you have to be able to estimate the value of the property and the mortgage loan amount sought. So those are really the things. So you have to take that into consideration. What is the quality of the information that you're getting? What are the guidelines that TRID says for the property address? What does it say I need in order for it to be a valid estimate of the value of the property? And what do I need for the mortgage amounts? Right? The first 3 are just no-brainers. You're going to get the customer's name, their income, social security number to obtain a credit report. Right? All they're saying is you have to have those 6 pieces of information. All right? That's why we ask you guys, when we give you the loan officer streamline for what we need in order to get your loan moving, it's with the consideration that we want to be TRID compliant, but at the same time, we also want to get your loan over to the processor so the underwriter can take a look at that file right off the bat and make sure that we're even going to move forward with this. The last thing you want is to send a file over to processing, not having done everything that you've done, order an appraisal, make the borrower spend a bunch of money, and then have the file get to underwriting and die. And now the borrower's out the appraisal money, they're out, the credit report, all of that money. So it's really incumbent on you guys to follow that streamlined process. All right. I'll tell you, myself and Ray and the underwriters, we run through the company pipeline once a week, and we spend a few hours on it. All right. We spend probably 2, maybe 3 hours going through every single loan that's come in within the 2-week period. So we're seeing all your files. So, the head of the company is looking at what you're doing. And it's not saying that to scare you, but we're seeing what the trends are. And if we are getting, on average, 60 files every 2 weeks, for example, or 30 files a week, we're expecting that at least, maybe a third or more of those files are going to get through. So when we're only going and closing 30 or 40 files a month, that's telling us that loan officers or somewhere along the line, the process is not working because the applications are coming in. So you're either just taking applications for the sake of taking an application and hoping that you throw things on the wall and they stick, or you're legitimately trying to get the loan done, in which case it's really incumbent on you to get that over to the processing team or the opener as quickly as possible. You know, you shouldn't be scared of asking the borrower for information. If they're serious about buying a property, they're not kicking tires, they're going to provide you those documents. It's only 5 things that generally most borrowers don't even have to go dig for them. All right, so now I'm going to go through a TRID sample timeline for you guys, just so that you get a real understanding of the flow. So in this particular timeline, we're going to say that it's a creditor like us. They're not open for business on Saturdays. The property is in a state where consummation is the day of closing or signing of documents between the consumer and seller. A lot of folks don't know what consummation is. I'm going to cover that here too. All the parties are targeting a closing date of December 30th, and the consumer's application is received by the creditor on a Monday, October 5th of 2015. So we're jumping back in the time machine. All right, so in this timeline, what we're going to show you, there's going to be some caveats in this one. This is not going to be a direct, ordinary timeline, because I want you guys to be able to see how things get reset, how timings get reset, if something happens in the loan period, what that does to the disclosures and the timeline in terms of getting to closing. All right, because a lot of you folks, you know, you understand, like I said, time transaction, you know, the agents are expecting to close on a specific date. So this TRID stuff becomes so important at that point. So what we're going to have here is we're going to have a receipt of an addendum to the contract. This is going to modify the allocation of transfer taxes, right? You remember we said that this was submitted on October 15th. Now this happens October 30th, so 15 days later, right? Then the appraiser provides a property value resulting in a loan to value ratio higher than 80%. So this triggers mortgage insurance. So all of a sudden now we got MI. This happens November 6th, right? Then we get an updated credit report obtained by the creditor shows a change in the credit score, right? So again, this is going to trigger an LLPA November 24th. Rate lock is requested by the consumer December 7th, so they haven't even locked the rate yet. Consumer decides to obtain an owner's title policy the week prior to consummation. So now here we started in middle of October. We're in December now. During a walkthrough 2 days before consummation, a broken dishwasher is discovered, December 28th. Then the recording fees collected were $100 more than needed when the documents are presented for recording after consummation, January 4th. So as you can see, this is like a perfect storm here. Every single one of these events that have occurred have delayed this, you know, through a period of almost October 15th to January 4th. Right? So we're talking 15, 20, we're talking about October 15th, and we got all of November, all of December. So 45, almost 50 days to close this transaction. So let's take a look at it. Here's our calendar. So we're starting October 15th. So again, we're seeing that the application was received on a Monday, right? At that point, the only thing that we can collect once we have the application is the cost of the credit report. So at that point, you got the application in, now you can go to them and you can ask them for the credit report, okay? Again, you can send the credit card off, or you can send the credit link, you know, if you have a paid Birchwood account or a credit card on file with Birchwood, then you can go ahead and request that. All right, so then you notice that once that happens, Tuesday and Wednesday pass, right? So we're in our 3-day window there, and on the 3rd day, the loan estimate is delivered or placed in the mail. All right, so we got Friday, that counts as a day. Then we got Saturday and Sunday, we're closed, and we got Columbus Day. So there's the 3-day holiday period in there, right? So on the 3rd day, on the 13th, right, within compliance of TRID, the consumer received the loan estimate. All right, so then the consumer looks at the loan estimate, says, this looks great. I'm going to go ahead and move forward with the intent to proceed with the application. And a copy of the purchase contract is received by you, the loan officer. At that point, we have ended the 7-day waiting period for consummation after delivery of the loan estimate. This is the earliest when consummation can occur. What is consummation? Glad you asked. So consummation, right, is not the same thing as closing or settlement. So a lot of people had this belief that, consummation meant when the loan could actually close. But consummation is actually when the consumer becomes contractually obligated to the creditor on the loan. So that's when the consumer becomes obligated to Obsidian, not, for example, when the consumer becomes contractually obligated to a seller on a real estate transaction. All right. So this loan estimate must be delivered to a borrower not less than 7 days prior to consummation. All right. If a loan estimate is revised, the transaction may not be consummated less than 7 business days after it has been provided to the borrower. So if anything changes, right, this is why it's so important when you're in there and you're doing your discount points and your fees and you're validating all that, that you're making sure that you go in there in Lending Pad and you take a look at that loan estimate and look at that closing section and look at those fees and look at what you're charging up front and making sure that you're not exceeding that 3% tolerance on points and fees before you send that out. All right. That way you're not going to delay anything there. All right. You can't rely solely on the opener to do that for you. The opener is basing what you're saying you are charging on that loan as being the valid amount that you want to charge. Right. The last thing you want to do is get all the way to underwriting and find out that, you overcharged or you have to adjust everything. Everything needs to change on there. All right. If a settlement is scheduled during the waiting period, the creditor may not use the revised loan estimate unless the settlement is postponed. All right. So you can't use it. The closing disclosure must be received at least 3 business days prior to consummation. If received within the 3 business day period, the date of consummation must be postponed at least until that period has elapsed. So I've had a lot of people ask me that, can't they waive that 3 days? Right. It's not that you can't, but regulatorily, it is extremely, extremely difficult to do. All right. And Obsidian doesn't do it. So the CFPB's explanation for choosing consummation over settlement or closing, obviously in a painfully convoluted explanation, the bottom line is that consummation is a old TILA term and settlement, which is synonymous with closing for our purposes, is a RESPA term. So that's the easiest way to remember these, right? One is a event, so it's basically a date that something happens. The second one, right, settlement is the actual process of it happening. All right. So the powers that be opted for consummation, which is more consistent with the single event closing process followed in some states, not always the case, right? So there's states, for example, like Oregon, let's give that an example, or Washington, California, Nevada, Idaho, Hawaii, a bunch of those other guys. Those are called escrow states, right? They have laws declaring that engaging in the business of closing real estate transactions for others is the practice of law, meaning that the service may only be provided by a licensed lawyer. All right. These are sometimes referred to as non-escrow states or attorney states. All right. So let's go back to our timeline here. All right. So next thing we have, our appraisal is ordered by the creditor. So we order the appraisal. And then a couple of days later, the title insurance is ordered by the real estate agent. And then all of a sudden, we get a receipt of an addendum to the contract modifying allocation of transfer taxes. That was our event that we had talked about, right? The first one. All right. So what happens then? That Wednesday on November, we have the last day for the creditor to issue a revised loan estimate. Again, because we have our 3-day lapse, and then we put the loan estimate out, and it's basically got to allocate that transfer tax. At the same time, that Friday, second part of the perfect storm, we receive a appraisal, and now the LTV is over the 80% that was originally in the loan. All right. So at that point, we have to issue the revised loan estimate, right? We got it on a Friday. So again, we're going to count. We got 1, 2, the 9th and the 10th. The 11th is a holiday. So it doesn't count because the banks are closed. And then the 12th becomes the last day for the creditor to issue a revised loan estimate. So we had to add the mortgage insurance cover it, change of circumstance, because now the LTV exceeds 80%. So we had a change of LTV. All right. Then on the 24th, the next storm happens, right? We get an updated credit report showing that the credit score has changed. So again, we've got to do a revised loan estimate. All right. So then that's falling the day before Thanksgiving. 25th, we have Thanksgiving, which is a bank holiday. 27th is a business day. Saturday and Sunday holiday. And then on the 30th is the last day where we can do another LE at that point. All right. This is another change of circumstance due to a change in the credit score. So you can see how all of these things are affecting the timeline, right? Having to go back and revise all of these loan estimates and how that's affecting everything. All right. So then the inspection contingency of the contract is removed by the consumer. Right. At that Monday, the rate lock is requested by the consumer. The loan officer goes ahead and requests the rate lock with the lock test. We agree to it. We execute it. Right. Then we have the last day for the creditor. Again, another 3 days pass, and we are on the last day to deliver or mail the revised loan estimate, reflecting that we have now locked the rate. Right. So we got to send out another LE. Right. Then on the 21st, the consumer informs the creditor of intent to purchase an enhanced owner's title insurance policy. Okay, so now we've got another change. So if we were delivering the closing disclosure by mail, the creditor must place the disclosure in the mail on that date, right? So now we got the closing, the CD's going out. All right, so the creditor sends the disclosure, overnight delivery. Customer receives and signs for the overnight delivery of the CD. Now we've got our right of rescission dates, right? So the earliest date now we can close is on the 29th, right? So we're going to count on our days there, our 3-day right of rescission. We've got the 26th, which is the day before Christmas. So Christmas holiday, we can't count that. Saturday, consumer has to receive the closing disclosure. Then on the 28th, we have another storm. The walkthrough shows that the dishwasher is broken. Seller credit for a broken dishwasher provided in an addendum to the contract. Creditor is required to permit inspection of the closing disclosure by consumer on this day, and then we have the closing date. All right, so the revised closing disclosure reflecting seller credit for broken dishwasher is provided to the consumer and the seller at closing. And then we have the recording indicates transfer taxes paid by the consumer overpaid by $100 and has to be refunded to the consumer. All right. So then February 2016 is the last day for the creditor to deliver or place in the mail the corrected closing disclosure showing a decrease in the transfer taxes paid by the consumer. All right. So on the 23rd, we have the last day for the creditor to mail the refund. So they actually got to send the money. First we send the disclosures, then we send the money. And then on the 26th is the last day for the creditor to provide the refund to the consumer. All right, so that's the entire transaction with all of the pitfalls and delays that can happen. So you can see just having one of these things happen, how that will adversely affect the timeline on your transaction. And, you know, LE mistakes, regardless of whose they are generally always going to be blamed on the lender. Right? We did something wrong. We didn't do something right with the fees. Oh, no, the closing's delayed and everything else. And that's why it's really, really important to make sure that you get all of that done correctly. So let's talk about doing loans the Obsidian way, the way that we want you guys to do things. When you get an application in, we want you guys to interview your borrowers, right? Before you're even thinking about putting an application in Lending Pad, let's get that out of the way, okay? It's really important. I know it seems like it's a time-consuming thing, and maybe some of y'all do it, maybe some of you don't, but I can tell you, the quality and the type of stuff that we're seeing coming into Lending Pad is showing us that some of the loan officers are basically just throwing the point of sale over the wall and then hoping the borrower is going to come back and fill things out. And, it's like I tell Ray, my analogy of it is, a dog chasing a car, and then the dog catches the car, and then the dog doesn't know what to do with the car. And that's how some of the folks are with loans. Oh my gosh, I got an application. What do I do now? I have no idea where to go with this. What do I do? Well, if you interview the borrower, you're going to know what the borrower's expectations are and what they're trying to accomplish. I'm going to show you that here in a few minutes, but that's one of the things you want to do before you even take the application. Don't spend the time sending over your point of sale and asking the borrower to run a credit report and everything else when you don't even know anything about this borrower. You've got to ask those hard questions up front, because you don't want to waste their time and you don't want to waste your time. So, you definitely want to do that. Once you've done the interview, at that point, you want to go ahead and do your loan streamline steps, which is sending out the application via the point of sale or directly entering it. You could start the application when you're doing your interview, kill two birds with one stone, right? If it sounds like the things are going to go in there and it's going to work, and hopefully, by the end of this training, you're going to have sort of an idea of what direction you're going with your loans. And then you want to hit them for the 5 documents, right? Which I said are documents that most of them are going to have right off the bat, right? They're going to have their ID cards. All they got to do is reach in their wallet. Income, they're going to grab 2 pay stubs. They should have those available. Their assets, 2 bank statements. Purchase contract, if they have one. If they're doing a TBD, obviously they're not going to have that, right? And the credit card off, right? You got to get authority to run the credit, right? Once you have the application, at that point, you can go ahead and charge for the credit report. So it's up to you. If you want to get the full application first and then ask them for the credit card off later, that's fine. But just know that you have to do it. Obviously, if you've gotten the application, remember what I said. If you have a full application, that's implied consent to run credit. If you're not going to get a full application and you want to get everything else done ahead of time, then go ahead and send them the credit card off to fill out, because they're going to need to agree to pay for the appraisal and everything anyway. All right. The next step is going to be ensuring that the application is 100% complete. That means going under the loan tab, right? The application tab in Lending Pad, and going through each tab and making sure that all of the mandatory information that needs to be in the application is there. All right. You can't skip over anything. The demographics, all of that stuff has to be 100% filled out. All right. Then you're going to run your credit, because at that point you've got 100% completed application. So you can go ahead and run your credit. You're going to do your income calculation. If this is a self-employed borrower, right, and they don't have, and they're providing you documents, they're providing you tax returns and everything else, one of the basic skills you have to have as a loan officer is to be able to read income documents, right? Everybody knows that. They teach you that when you go get licensed. But again, there are tools out there to make that really easy for you. So Fannie and Freddie have approved forms. They have a 1084 form, which is basically an income calculator. It tells you take Section L of the tax return, or take Schedule C, go to line 11 and put that amount in here. Go to Schedule F, put that amount in here. By the time you do that and you get to the bottom of the page, it's going to tell you exactly what their income is. There's a product called Blueprint.io. Blueprint.io, it's a paid program. It's really nice. You just upload all the income documents and it does some magic razzle dazzle on the back end, and it spits out the income for you. That is Fannie and Freddie approved. All right. So you can only use the ones that are Fannie and Freddie approved in your loans. All right. Whatever the outcome, whichever one you decide to use, you have to upload that into Lending Pad. All right. The processor, the opener, is going to kick your loan back if it's a self-employed borrower and you don't have those forms available in there. All right. Then you're going to run your AUS, right? If it's a conventional loan, you're going to run DU and LP. If it's an FHA, you only need DU. You need an approved eligible for your file to move forward. Okay. You're not going to send the file over to processing or to the opener with the TBD anyway. So until your borrowers finish shopping and everything else, it's not going to go anywhere. They can't underwrite it. They can't order title work on a property that doesn't exist. So, if they're telling you they're going shopping, find out what their timeline is. You know, how long do you think you guys are going to be looking? Is it going to be 30 days? Is it 3 days? Are you going to pick something over this weekend? You know, whatever that time frame is, just be ready. You know, again, you're going to complete both the loan submission and process your cover sheets. If you go under print form settings and you go to client specific forms, you'll see those. Those need to be completed with every single loan file. All right. The loan submission is basically telling the underwriter, I did my job. And the processor cover sheet is basically telling the underwriter, here's how I did my income calculation. You know, and here's what the borrower provided. This is 24 months of bank statements, 12 months of personal and business, whatever they provided, you're going to select in that cover sheet. And then you're going to let the underwriter or the processor know via the note section that you have completed those forms and that they are in the print form section. All right, the title estimate, right? You can get your title estimate or the LOA can get your title estimate. The title company info is going to be under the purchase contract. All right, it's going to have their contact info in there. All you're going to do is send an email and say, hey, I need the title estimate for this address, right? You're going to send that to the title contact. More than likely, they already know. They've already gotten, you know, a copy. They know they're going to be the ones that are going to be settling that thing, and they're going to send you back a bunch of PDFs that you're going to upload to show that you got a title estimate, right? When you get the title estimate's going to have the title fees, right? Title fees need to be on the disclosure. They don't just show up in there automatically. So you have to go into the disclosure tab and add your title fees in there. All right. At that point, when you're pricing your loan, you also have to decide, am I going to charge points and fees? Right? Is the pricing underwater? Does the borrower want to pay some discount points? Right? Am I going to charge origination fees on the front? Right? You do that, and then you click on that compliance test button, and that's going to tell you if you got 3 passes in there. It's going to tell you you're compliant. That your numbers are good, and if there's extra money in there, it's even going to tell you that. It's going to say, you know, this is under, you know, the compliance guideline by $3,000. So now you know, hey, I can add some more to my origination fees if I want, right? You got to decide if you're going to price the loan, if you're going to lock it then, or you're going to float it, right? Floating means I'm not going to lock it. I'm just going to, you know, shoot the dice with the market and see hopefully the rates stay the same, and I'll wait until you know, I get the clear to close, or I wait till it gets to the underwriter and then I'll lock it. Or you might say, hey, you know what, I'm going to go ahead and lock it for 45 days before I send it in here. The processing, it should close before then. All right, that's up to you as a loan officer. If you don't know what you're doing, lock it before you send it to processing. You know, if you're somebody that follows the market and understands how the bond works and all that good stuff, and you feel like, hey, I can play loosey-goosey, that's fine too. At that point, you're going to send your pre-qual or pre-approval, and at that point, you can go ahead and submit it to your opener. All right, so that's it. As you notice here, I say first 48, just like the TV show. So in the first 48 hours before your application gets cold, then you should be getting all of this stuff done. All right. Set yourself a realistic goal. If it's not 48 hours, within 72 hours, you want to push that file into pre-processing. All right. You should be doing that with every single one of your loans, right? We're not asking you guys to collect every single document that's required. We're asking you to get these 5 things. The underwriter is going to condition for everything else. All right. That's needed. We just need you guys to, you know, get a good application, do these couple of little things with your LOA, get it over to the pre-processing folks, and let them go ahead and handle it from there. The underwriter's going to look at it at that point, and they're going to tell you if it's going to work or it's not going to work. All right, so just let's make sure that we're trying to get that done. There's just a lot of loans sitting out there that aren't going anywhere. And I look at them and I look at people and I'm like, I know I send out policy emails that say you got 48 hours to do this, or you got to put your LOA on your loan, and people just don't do it. And I'm not quite sure why, because you're only shooting yourself in the foot not doing it. All right, so Questions you should ask your borrower when you're taking an initial application. All right. This is really important because a lot of folks, like I said, you just get a little bit of information from the borrowers, throw them the POS, throw that over the fence, hope that the processor or Holly or Cynthia are going to be able to do something with it. Throw that Hail Mary pass. That's not going to help you. All right. So, like I said, don't just send out your point of sale for an application without knowing what the borrower's objectives are. All right. So, first of all, you want to ask them what the purpose of the loan is. What are you going to be using this money for? Are you buying a house? Are you refinancing? Is it a cash out refinance? Is it a HELOC, HELOAN, HECM, reverse mortgage? How much gross income do you bring in a month? All right. Nobody calculates income correctly nowadays. We have a few people that do, everybody else doesn't. So ask them up front. It makes it a lot easier to know what they're bringing in every month rather than getting a tax return and trying to sit there and calculate it out yourself. Do you have a 2-year continuous work history? That's another important one. Oh, yeah, well, I worked for 1.5 years here and I just started a new job here and I've been there for 3 months. Right? Remember, the underwriter is always looking for continuity in the job. Not only in the job, but are they in the same field? Yeah, I was a doctor at Detroit Mercy for, 4 years, and now I've moved on to, to Michigan Medical, right? And I've been there for 3 months or whatever. Are you self-employed or a W-2 employee? That's really important. That's going to tell you how much work you're going to have to do here. Right? If you're self-employed, there's going to be probably alternate doc, right? You're either going to be doing a bank statement loan here. If they have good tax returns, if they W-2 themselves, then it's going to take you in one different direction. But if they don't have that, or they're writing off everything in their taxes, that's going to take you in a totally different direction. What do you think your current credit score is? Pretty much everybody's on Credit Karma, or they're using Experian or whatever. It's always good to have that information up front, and I'll tell you why here in a little bit. How much are you paying for your current housing? It doesn't matter whether you rent or you own or whatever, right? You need to know what they're paying. You got to know what they can afford. Do you have any credit card or student loan debt? Right? Credit card debt, you're going to always see almost everybody has that, but student loan, that's a big one. A lot of people have forbearances, or they're not paying, or, they had the COVID stuff. There's different things, different situations. Student debt is never really one of the good ones. Everybody knows this country has a huge amount of student loan debt. Then you got to ask them what you have saved for a down payment. So how much are they going to put down? Obviously there's down payment requirements for different loan programs. Do you have a co-borrower? Right? That's going to be important as well. That means more money, right? Maybe better credit scores. Are you working with a real estate agent? So are you serious? Have you already started looking for a home? Are you trying to sell your current home, right? That's going to make a big difference on closing. How quickly are you looking to close? 30 days, 2 weeks, 2 months, new construction, just building your house, all of those different things. Do you need a pre-approval? And do you have a home in mind already? All right, that's really important, because if they have a home in mind already, that means that they're going to be pretty quick to get you a purchase contract if you can get them a pre-approval in a hurry. All right, and you want to be the first one to the draw, because I'm going to tell you, why do I say first 48 is the most important? Because during that first 48 hours that you are getting that application, they are out shopping that loan to other people. All right. And if you're not getting them that pre-approval letter and getting that loan qualified in that amount of time, all that work that you did, interviewing them, taking the application and everything, for them to say, nah, I'm going with Rocket, or they just stop communicating, which a lot of you have seen happens a lot. At that point in time, you've just wasted your time, right? And they've wasted your time. So speed is the key here. You know, the need for speed, like they say, that's really what's going to get you going the quickest. You can't have a lackadaisical attitude about your loans. When you're getting an application and you've done that interview and you've dedicated that hour or half an hour of your life that you're never going to get back, you want to make sure that these people are serious and that they're going to move forward. So it's always better to have this conversation with them on these questions before you even start the application process, right? Because if any of these things right here gives you red flags, you're probably going to want to tell that guy, you know, hey, you know, as hard as it is, the hardest thing for brand new loan officers to do is to walk away from what they think potentially could be a deal. And it's everybody's mindset to want to succeed and to make a loan work no matter what. And like they say, you got to know when to hold them, know when to fold them. In some cases, you just got to fold them. So here's something very simple for people. You know, what's a conventional loan? Conventional loan means it's not a part of a specific government program. All right. Two main categories of conventional loans: conforming loans, right? Conforming loans have a max loan amount that is set by the government. All right. So when you're in lending pad and you put in a property, you put in a property address, if you look right below that, it's going to tell you what that limit is right off the bat. Other rules for conforming loans are set by Fannie or Freddie Mac. Conventional loans generally that are not government loans generally follow the Fannie and Freddie guidelines. Why do they do that? Because they want to sell those to Fannie and Freddie. You know, it's that simple. Non-conforming loans are less standardized. Eligibility, pricing, and features can vary widely by lender. So it's particularly important to shop around and compare several offers. Why am I telling you this? Okay, because you have to understand with Obsidian how all of this works. All right. So if you are going delegated with us, this is all for pricing for you guys, right? If somebody comes to you and you've done the interview and they're asking you to provide a quote, it's really important, number one, to know where am I going to go with this loan? Am I going to be able to do this delegated in-house, which is going to pay me more money? Am I going to have to go non-delegated, which is not going to pay me as much? Or am I going to have to go on the wholesale where I'm capped out at 2.75, right? So these are the criteria, right? So if it's a conventional, a VA, or an FHA loan, that's always going to be delegated. You're always going to be able to do those types of loans in-house with our folks, right? You got to remember we're a fully delegated lender, which means that, you know, you're going to put the loan in lending pad. The whole loan is going to be done in lending pad. Processing is going to be done by us. Underwriting is going to be done by us. All the disclosures that go out to the borrower are going to say Obsidian on them. You're going to price these deals in Optimal Blue with the delegated dropdown. They're going to be closed by Obsidian and they're going to be funded by Obsidian. All right, so then you got your non-conventional programs, right? And there's very few programs that are going to probably fit in the non-delegated channel anymore. All right, there's only a few. And, you know, they're pretty few and far between. Ray made a decision a while back that we're not going to really do those anymore as much on the non-delegated. But the ones that we do have non-delegated, those are going to be started in lending pad. Processing is going to be done in-house. The difference with non-delegated is that the lender or the investor that is purchasing that loan from us is going to underwrite it. So we're going to push that over to them to underwrite. They're going to draw the docs in most cases, but the docs are still going to say Obsidian. It's still going to be priced in Optimal Blue under the non-delegated drop-down. It's going to close by Obsidian, and Obsidian still funds those. All right. And then your wholesale is your non-conventional, your I-10 loans, your foreign loans, your subprime loans. All right. If you don't know what those are, Google is your friend. You know, so, you know, if you're not familiar with what types of programs those are, look at the Fannie website, look at the Freddie website, see what their guidelines are. That's going to really tell you a lot, because if it doesn't fit under those, you know, believe it or not, I-10 loans can be done as FHA loans. A lot of people don't know that, but if you look at what the requirements for an ITIN loan are for a, and for those of you that don't know what an ITIN loan is, it's for a basically somebody that's a foreign national that's here on some type of a visa, whether it's an H-1B or whatever. The FHA loans can still be done for those folks, right? But the criteria is really stringent, and most ITIN borrowers are not going to fall into that category, right? So your wholesale loans are going to be your non-conventional, your foreign national loans, and your subprimes, right? So those are going to start in Lending Pad. You're still going to take the application in Lending Pad. Once you've gotten the application on the docs, what happens then is your LOA is going to actually put that in the TPO. What's the TPO? It's a third-party software. Okay, so that goes from our LOS to their LOS. Everything is moved over there. Obsidian, the LOA processes, so your LOA will process that file for you. The difference being that we do not support those in-house, okay? So if you're going wholesale, the AE at the wholesaler is the one that's going to support you on that loan. So if you have questions regarding that loan program, about locks, about any of that information, you have to go to that AE. That's the person that's going to help you out with the loan. You know, our regional manager, no helpy, okay? So you're going to have to go to them. They may help you with the initial application before it leaves Lending Pad, but once it's in the TPO, we have no visibility on those loans. All right, so we really can't help with those. But the wholesale AE should be helping you and assisting with getting a loan priced and locked with them. They're going to underwrite it. They're going to draw the docs in their name. Wholesale loans fund immediately. So essentially what happens is when everybody gets paid, they cut us a broker check that goes right to Obsidian. It's not like conventional or non-conventional, delegated, non-delegated, where we have post-closing. There is no post-closing with wholesale loans. And once you complete everything in the TPO, every part of that loan, documents, their disclosures, all of that have to be moved back into Lending Pad. So you have to get everything back from them, get the application back, all that information, locks, all that stuff, and that has to be uploaded back in the Lending Pad. So the wholesale process, a little bit more convoluted, but you're going to find that you're going to have a lot of options to do, a lot of loan programs in there that Obsidian will not do. Oops, sorry about that. All right, so what's new? So the conforming limits right now, $647,200 in most counties. All right. What's the most important thing to know here is if your down payment is less than 20%, you're going to typically need MI. All right. And they say 20%, you know, but it should be below the 20% in order for the MI to be waived. All right. Conforming jumbo, that's for loan amounts higher than $647,200. So once you exceed that, they consider that a jumbo loan. Again, the county limit, when you put in the subject property address, as soon as you populate that, you're going to see down in the bottom under subject property, the actual county limit's going to show there for you. So it's going to tell you exactly to the penny in Lending Pad what that amount is. So your jumbo non-conforming is up to 1 to 2 million, right? Conforming jumbo limit in the county is 1 to 2 million. Rules vary by lender, but usually need good credit and high down payment to qualify. Loans of any other size do not fall in another category. Some loans in this category are intended for borrowers with poor credit. All right, these allow for minimum documentation of your income, and some of these loans allow you to pay only the interest. All right, so non-conforming others. These are going to be loans that are properties with non-standard features. So in other words, more than 10 acres of land, agricultural income, properties that are difficult to appraise, And these are loans for affluent customers. These are your self-employed borrowers, your doctor programs, et cetera, et cetera. Again, like I said, square peg, round hole. Not every loan application is going to work. You have to learn to walk away from a bad loan. As bad as it is, it's going to be more of a headache for you if you cannot close that loan and you spend a lot of time and a lot of hours working on it. All right, so here we go. So 2023 minimum mortgage requirements by loan type. All right, so here's the new guidelines for 2023. All right, so the conventional down payment 3%, FHA 3.5%, VA 0, USDA 0. Conventional credit score of 620, FHA 580 with 3.5 down, 500 with the 10% down. All right, a lot of folks don't know that. So even if they're under 580, they can still be done. VA loans, no minimum. 620 is the lender standard, however, and USDA 640 is the lender standard. All right, there's your PMI percentage, 0.14 to 2.33. Upfront MIP of 1.75% on FHA. Annual MIP of 0.45 to 1.05. And then with VA, obviously, you have a 0.5 to 3.6 VA funding fee. And the upfront guarantee fee on USDA, 1%, annual guarantee fee, 0.35. Now, just a quick differential for you guys. Does anybody know how many points and fees you can charge on a VA loan? Anybody? Okay, so VA, somebody's going to say.
Points and fees is 3 total.
Not 3%, but not on VAs. How much can you charge on VAs? VAs are 1%. All right, just so people know. All right, so again, now you'll see that the DTI ratio has been raised to 45% on conventional, 43% back end on FHA, so that hasn't changed. VAs are 41% and USDA 41%. Right? Loan limits, 726,000 on conventional, 472 FHA, and not applicable on VA and USDA. So here's the important distinction, right? You see these numbers here, but even though the credit score minimum on a conventional is 620, our warehouse requires a 640 conventional and a 580 score for FHA loans. So we cannot do a 580 on our delegated or non-delegated. If you've got a score below 580, that is generally always going to be wholesale. We can go all the way down to 500 with the 10% down. Just remember that. If it's 580, it's 3.5. But if you've got a borrower that is below the 580, if they're at 579, that requires 10%. So you have to keep that in mind when you're talking to your borrowers, especially on the FHA side of things, because most of the time they're going FHA because they do have a lower credit score and less money to put down. So sometimes doing the 10% down is a stretch. And, if they're in the credit score in the, 500s or something like that, they may want to go ahead and look at, rather than trying to put the 10% down, spending that money and going and getting some credit repair done. Okay. You also have to remember the higher DTI ratios may be considered if the borrower has higher reserves or high residual income. You have to ask your underwriter about that. So if you're in one of those circumstances where they're, just inching below the 580, check with Holly and Cynthia, let them know, hey, this guy's got $100,000 in the bank or whatever. And then, and obviously if he's got an extremely low DTI, not a lot of risk or whatever, check with the UW because they may let it slide by on the delegated side. So you always want to ask that question first. But if you're looking at a really bad credit score, very little money in the bank, they don't have the 10% to put down, that's probably going to be a credit repair. If they do have the 10% to put down, you're going to wholesale that to somebody like EPM or one of those other folks. All right. All right. This is really good news here. Lenders are now allowed to take an average median score to meet the minimum credit score, which is great news for borrowers if they need two incomes to qualify. But one of your applicants has really crappy credit below 620. In the past, that meant that the loan was denied. Now, a high credit score borrower can potentially lift the low credit score borrower over the 620 threshold. So basically, what they do is they do a blended score, which can lead to a loan approval thumbs up instead of a hard no. Bad news is the cost of credit reports is going up in 2023. It's across the board for all credit companies. We're still offering a flat fee of single or dual credit pulls. I will tell you this, that our old pricing under Credit Plus was $75 for a dual. So now we're just back to where we originally were because we were charging $44. That's going to double up to 70, I think $72 is what they're telling us it's going to be now, but it's still going to be a flat fee. So if you're doing a dual, we're not charging them more money for it, either which way they go. And that's not our policy, unfortunately. That's just what's going on with credit now. But the blended credit is a great news, especially if you've had a borrower that was just, if you've got a loan that was sitting in there and the borrower was just on the borderline or on the fence with their score, and they had another co-borrower in there that had a great score, and you had to deny the loan. Go back in your pipeline and look at it now. Because you may be able to rerun that, and now all of a sudden, boom, they're going to qualify. All right. All right. So here, just a few things to know, right? Employment. Lenders require proof of steady income, right? 2 years. Variable income earned from commissions, bonuses, or overtime. Right? If you run your own business, Fannie and Freddie will usually require 2 years worth of personal and business federal tax returns. All right. So you could do that, or they can go do bank statement loan at a higher rate, right? Bank statement loan, they need bank statements and a P&L. The P&Ls don't even have to be certified anymore by a CPA. They just need a P&L and they need 2 years worth of bank statements. You always want to make sure that when you're getting the bank statements and everything and you're doing the income review, make sure that the deposits in the bank statement and the withdrawals in the bank statement line up perfectly with the monthly amounts that are showing on the P&L. All right, that's going to be a red flag for the underwriter if they don't. So you want to take the time and just, put them side by side and say, okay, I saw 7,000 come out here. Here's 7,000 going out of the business on the P&L. Here's 7,000 coming in. Here's 7,000 coming in. All right, income limits, except for Fannie Mae's Home Ready and Freddie Mac's Home Possible. I'm going to talk to you about those in a minute. Most conventional loans don't have income limits. All right. So debt to income ratio, lenders measure your DTI ratio by dividing your total debt by your gross monthly income. That's why I told you it's so important, because most borrowers, when you're first interviewing them, they're not going to know what their DTI is, right? You could throw them over the DTI calculator and say, here, calculate your DTI. But just being able to do that, if you get their gross monthly, you're going to be able to accurately figure out what that DTI is based on what their current debt is. All right. So again, DTI now is 45% or less, but they may bump it up to 50% with higher credit scores and additional mortgage reserves. Again, that's an underwriting decision. So if you're looking at somebody like that, this is why it's so critical to get these loan applications over to underwriting as quickly as possible. Because Holly, is just a, ninja when it comes to making this stuff work. So the faster you get it over to her, the faster she's going to be able to look at just that basic 5 docs in that application and tell you if everything's going to work, or she'll be able to tell you what you need to do to make it work. Cynthia, same thing. All right, cash reserves, right? So lenders may require up to 6 months of cash reserves. It's based on the program. When you review your AUS findings is going to tell you what that reserve amount is based on what loan program you picked. That's why it's so important to read your AUS as well, right? Because if you don't have enough reserves in there, you're going to fail. Your AUS is going to fail. All right. Occupancy. Obviously, one big advantage over conventional loans, over government-backed loans, is that borrowers can purchase a second home, commonly called a vacation home or rental property. Government-backed loan programs only allow you to finance a primary residence you live in full-time. All right. That's an important distinction for you. All right. So you're not going to offer somebody who's trying to buy a second home a government-backed FHA loan. Property types. Conventional mortgage requirements allow you to finance a 1 to 4 unit home located in a regular subdivision, condominium project, co-op project, or PUD, planned unit development. Manufactured homes. I always get this question. Notice what it says there. Manufactured homes have to be on a permanent foundation. They can't be up on 4 bricks. When you're doing a manufactured home, normally they're going to require an engineer's report. All right. To let people know, yes, this is mounted on the foundation. Florida has very stringent rules about it. And it has to be, you have to have an engineer's report. Florida, for example, they want to see that you got hurricane straps, all kinds of other stuff has to happen. So you want to make sure that if somebody's telling you, yeah, I'm buying a mobile home, or where are you going to put it? Do you have a foundation? No, I don't have a foundation. Not going to be able to do that for you. All right, let's talk about home ready and home possible loans, because a lot of people want to do these. They don't really understand them. So I just want to go into them real briefly for you. These are conventional 3% down payment programs, right? They have strict income limits, right? You can determine the maximum amount of income based on your address using the Fannie Mae and Freddie Mac online lookup tools. So there's 2 tools. All right, you can Google this. The area median income lookup tool. All right, so everybody should be using this, because I see a lot of people just pick Fannie Mae Home Ready because they say, oh, the income and the income and the down payment match. So I'm just going to go ahead and throw this in there. All right, you have to determine if that is going to work. So use these tools first. All right, for home possible loans, you want to use the income and property eligibility tool. All right, you can get both of those from the Fannie and Freddie websites. If you Google Fannie Freddie and put that in there, it's going to take you right to it. All right, the other thing to remember is home ready, and you have to tell your borrowers this: home ready and home possible borrowers must complete a home buyer education course before closing. One change in 2022, home buyers applying for a home ready program won't be required to use Fannie Mae's home buyer education program. Both programs offer a little bit extra wiggle room, right? Flexibility for borrowers with no credit score. So, wow, I'm a brand new, I'm 19 years old. I'm moving out of my mom's basement. I've got money, right? But I don't have a credit score because I haven't, built up a credit yet, right? So if they can prove their credit worth with alternative data, for example, lenders may accept 12 months of consecutive on-time rent payments. So I'm renting my basement from my mom and I got receipts, right? Along with utility bills and car insurance program payments, right? To show that they have a history of paying their bills on time. Adding income from a long-term roommate. That's another big one. You can add rental income received from someone who has lived with you for at least 12 months to help qualify for a home ready loan. This is called boarder income. And to use it, you'll need proof that the person has lived with you for a full year. So if they live with you, typically, you're smart, you get a lease, you fill a lease out with them, you agree to a rent, they pay you, they give you receipts, all that good stuff. If they have that and they can document that, that means you can use it. All right, current minimum mortgage requirements for FHA loans, right? Minimum down payment, 3.5%, credit score 580. Anything below 580 with Obsidian has to be brokered. 10% down with scores below 700, 759, 779, like I said, 579. FHA borrowers must pay 2 types of FHA mortgage insurance, upfront mortgage insurance premium, 1.75%. When you choose FHA and lending pad, it automatically calculates that for you. So you don't have to worry about adding that in there. The second is the annual mortgage insurance premium, MIP. That's also added in there for you. All right. Again, credit score, we've already talked about that. 500 with the 10% down payment. FHA approved lenders also use the credit alert verification reporting system, or CAVERS. So if your person has student loans, you got to remember, we're going to run CAVERS on them. So if they're delinquent or they've got any issues with their student loans, CAVERS is going to pick that up, right? If they're in forbearance on their loans, CAVERS is going to pick that up. All right. Again, steady income of 2 years that can sometimes be overcome with extra documentation explanations. I haven't really seen that happen too much, but if they can get letters from HR or some other caveats, maybe the company closed due to COVID, they were forced to go somewhere else, they're guaranteed the same income, et cetera, et cetera. Company merger, maybe the company changed names, maybe they even changed payroll companies. You got to look into all of those different things with them, especially when you're interviewing them and you're asking them about the employment. And they say, I was working here for, Joe's Tractor Feed for, a year and a half. And then all of a sudden they closed down because they got bought out by a new owner. And now it's called Bob's Tractor Feed, but it's still really the same company, things like that. All right, again, self-employment, there's a lot of ways to skin that. So again, like I said, if they're self-employed, you want to ask them, what type of documentation do you have? Do you write off a lot on your tax returns? I had a lady who had, $5 million in the bank, but her tax return said she made $1,700. So I mean, you got to ask them that, right? Because again, maybe they can't prove their finances or their worth through tax returns or anything else, but generally they have really good bank statements and stuff. So definitely want to be able to do that. Again, we know debt to income ratios, we've already talked about that. Energy efficiency debt exemption. So if you're buying an energy efficient home, you may qualify with a debt ratio as high as 45% and a credit score as low as 580. Bet you a lot of folks didn't know that. That's something to keep in mind, because a lot of homes that are being built now are energy efficient homes. They got solar panels, they got all this different stuff, and they're giving a lot of exceptions for that. So always keep that in mind, when you're shopping with a borrower. Cash reserves, FHA loan qualifications don't usually require cash reserves unless you're buying a 2 to 4 unit home or trying to qualify with the lower credit score. All right, so if you're below the 580, putting down 10%, et cetera, they're going to want to make sure. So, all right, this is also important. Unlike conventional guidelines, FHA rules allow you to use money from an FHA cash out refinance towards your required reserves. You can only take out an FHA loan to buy a primary residence you intend to live in for at least a year. FHA loans can be used to finance 1 to 4 unit homes. FHA approved condominiums, cooperative units, and manufactured homes affixed permanently to land. Again, concrete foundation. Home appraisals, you need an appraisal to buy a home with an FHA loan regardless of your down payment. All right, let's talk about VA requirements. VA does not require a down payment. However, you may need one if you're trying to buy a new home while you own another home with a VA loan that won't be paid off by the closing. So in other words, VA, you get an eligibility certificate, right? Let's say it's $200,000. You spend $100,000 on your house. You still have $100,000 worth of eligibility on there. Now you're going to go and buy a $300,000 home. You have to get rid of the other home and have that applied back to your VA certificate before you can go ahead and try to buy the home with zero down payment. All right, no mortgage insurance is required on VA loans, regardless of your down payment, but you do pay a VA funding fee between 1.4 and 3.6, depending on the down payment, okay? And whether you've used your home loan benefits before. So in other words, if you're not paying something down, you're still going to have to pay the funding fee. And based on whether you're not making a down payment or you are, is going to determine how high the funding fee is going to be. VA guidelines don't set a minimum score, but they say 640 here. So, 620. And again, like I said, for us, 640 is our warehouse limit. You need a 2-year history of employment. VA guidelines give some flexibility if your employee varies, the income is stable and likely to continue in the future. So a little bit less stringent there. VA guidelines are similar to conventional lending guidelines for self-employed borrowers. And VA borrowers need to prove they earn stable income that covers not only their mortgage and other mortgage debt, but also living expenses based on their family size. So they take into consideration cost of living, all of that stuff, right? And of course, the cost of living is based on the region that you live in. So if you live in California, obviously that's going to be a little bit more expensive for you. Residual income, VA calculates how much money is left over in the veteran household after standard paycheck deductions, right? And there's a maintenance income calculator, expense calculator. Debt to income ratio on the VA, 41%. Lenders may approve a higher DTI if the residual income is at least 20% above the guideline. So remember, 20%. Cash reserves, VA loans don't require cash reserves. Have to live in the home. You can finance the same types as FHA, single family, condominium, manufactured home, 2 to 4 unit. VA approved lenders must order appraisals through the VA's online system. So you can't just go to an AMC and order an appraisal. When we do VA loans, we have to order them through the VA. So don't, tell your borrower, we'll go ahead and order your appraisal. We got this guy locally in your neighborhood who can come out and do it and everything else. No, that's not going to work. So you also have to remember that VA appraisals and FHA appraisals are transferable. So if they leave you and they go to another lender, they can transfer the appraisal. USDA loans, down payment, USDA doesn't require any. USDA, it has to be rural land, so it has to be, basically designated as agricultural or rural, right? Mortgage insurance, rather than mortgage insurance, USDA loans require guaranteed fees. Upfront fee is 1% of your loan amount. That's rolled into your loan, so you're really not paying that. And then an annual fee of 0.35%. USDA doesn't set a minimum score, but USDA approved lenders usually require at least a 640. That varies with us because, again, it is brokered, so it depends on who you're going to broker that deal with. You also have to remember that you do not run DU or LP on USDA loans. They are not Fannie and Freddie loans. They are USDA. They have their own automated underwriting system called GUS, GUS. So in order to run GUS, you have to be signed up with GUS. Obsidian is signed up. You get your GUS credential, and then you run that finding, and then you upload that to the TPO if they don't provide it. USDA loans, typically AFR, a couple of other lenders out there do those. AFR does a lot of them, so they're probably the person, if you have a USDA, that's who you want to run to. USDA requires documentation of employment for all adult members of the household. All right, no cash reserves, DTI 41%, financing on primary residences only. Again, like I said, USDA designated rural areas, and properties are capped at 2,000 square feet with a guideline minimum of 400 square feet. So that's an interesting one. Same thing, single family homes, manufactured homes, condos, home appraisals, always required. Second homes, you can buy a second home. You must live in the home part of the year, only purchase a one-unit home. You must be able to live in the home year-round. Property can't be managed by another company or used as rental income. That's important, and you'll need at least a 10% down payment on second homes. All right, investment properties. Down payment is typically going to be 20%. That's pretty much across the board with all of our lenders. So if somebody tells you that they are wanting to buy an investment property, know right off the bat, you're going to ask them, how much they have to put down. If they can't say 20%, You're probably not going to find anybody. There's a few that'll do 90, but it's few and far between, and the requirements are a little bit more stringent. And if they're putting 90, I can guarantee you the rate's going to be a lot higher than what it would be if they're doing the 20% down. They're going to need an appraisal that analyze market rent, credit score of at least 640, cash reserves is 2 to 6 months worth of mortgage payments. Right? They can use the rental income if they have leases available, et cetera, et cetera. Those can count towards income as well. To buy a multifamily investment property, again, 25%, 640, minimum credit score is 660 for a 3 to 4 unit, DTI ratio of 36% or less, and 6 months of cash reserves. All right, just to talk about all the other documents, everybody should know this. We have these document lists available, but here's the list of documents that most lenders need, just so that people are aware this is what you're required to have. So I'll leave that up there for a quick pop. But again, we're only asking you to get the 5 documents. We'll condition for everything else that's on here. So get that 5. All right, some other mortgage things to know about in 2023. Low rates now available for home ready and home possible loans, offset rising rates in 2022. Fannie and Freddie Mac eliminated many of the pricing markups. So you might want to look at those, if the person meets those qualifications, look at that, if they're going for an FHA loan or something like that, look at the home ready or home possible options using the calculator tools I told you about earlier. You'll pay a higher rate for a second home. Buying that vacation home will cost you more every month after Fannie and Freddie added significant markups. So the second home mortgages have gone up, but the primaries have gone down. So, all right, which way to go with your loans? Again, here it is. When you're interviewing your borrower, here's things to look for. Right? They have a high credit score, can make at least a 20% down payment, eligible for a home ready or home possible program. Those are going to be qualifying for conventional loans. All right. So that you're going to know, okay, I'm going to price that delegated, right? Qualify for an FHA loan makes sense if you have a credit score between 500 and 619, right? Again, ours is 580, right? So you have at least 3.5 down payment and a 580 credit score. Again, if it's below 580, and they can put down the 10%. You can wholesale that to lenders like EPM. They'll do those all day long. You want to buy a 2 to 4 unit home with a 3.5% down payment. So if the borrower tells you this when you're interviewing the borrower, you know which direction to go. You go FHA, right? Again, you can price that on our delegated channel. You'll see there's the option in Optimal Blue to select FHA as the loan program. Qualifying for a VA loan may be the best choice if you're an eligible military borrower. So if the guy tells you he's in the military, you're going to ask him, hey, do you have your COE? Yes, I have a COE. Okay, great. How much is on there? How much have you used it before? They don't want to make a down payment. It's an excellent option. If you live near a military base, you're going to, when you're talking to borrowers around there, always ask them that question. Don't want to have to pay mortgage insurance. Great way to avoid that. All right. USDA loans, those are, sort of a Hail Mary as well. If you have a borrower that's really poorly qualified, but you know that they're living somewhere where there's a suburb or a rural area or farmland, or you're in a state where there's farmland, if they have a low to moderate income, they're in that area or they're willing to buy in that area and they don't have money for a down payment, you can look at the USDA option for them as well. All right, so let's close up with our takeaways here for Obsidian. Remember, garbage in, garbage out. If you put a garbage application in the system, that's what you're going to get out of it, garbage. All right, you want to interview your borrowers before you take the app. Get those questions out there, get those answers, do your investigating, before you put yourself in a situation where you're spending a lot of time. Don't just throw that point of sale out there. All right. Once you put that point of sale out there and they start that application, remember, you're legally obligated at that point by TRID. You're obligated by ECOA to do more work. So interview them before you do it. That way you can say, yeah, I don't think this is going to work. Maybe, try Nexa or somebody else or whatever. Um, Loan streamline process. Apply that process to every loan. All right. Unless you're going wholesale and beyond the shadow of a doubt, you're going to have to go wholesale on the loan. If it is going through the correspondent, delegated or non delegated, streamline, first 48 hours are critical. Don't forget you got competition out there. Those guys are going to do everything in their power to steer your borrower away from you. You don't want to lose that deal. All right. So 48 hours, man, get it done, right? First 48. Get it over to the processor, get it over to the opener. As soon as you are out of that TBD status, get that loan over to them so that the underwriter can start doing their job and pre-underwriting that thing and tell you if it's going to work or if we even want to be bothered with it. All right. Those are the most important things that you can do. We want you guys to make a lot of money. You're taking the time, you're putting the applications in Lending Pad. We're seeing the applications coming in, but what we're seeing is a lot of incomplete and a lot of stuff where you guys aren't doing the things that you need to do. So I'm telling you, follow this process. It is going to work for you. It's going to make your life a lot easier. And that's how you're going to really make the money. We want you guys to focus on going out there and selling. Your LOAs are here just for the purpose of helping you. All right. They are your right hand. We don't want you guys investing a lot of time chasing docs and dealing with your borrower. Once you've done that interview and you've sent out that application and you've sent them, introduced them to your LOA and you've asked them for those 5 docs, let the LOA handle it from there. Let them handle it, move on to your next file. They're going to push the borrower to get the docs in as quickly as possible, and they're going to move the file along, and they're going to work with the opener and the processor and the underwriter to get it done. All right. So it's really, really important that you guys follow that protocol. We're trying to do as much for you as we can, and we want you guys to start the new year. It's going to be a hard year next year on loans. So it's really going to be more about getting out there and selling than it ever has been before. So, we definitely want you guys to do that. So that's all I have for this last of 2022 training. I hope it was really helpful for you guys. Does anybody have any questions? All right, great. No questions. I love that. I have taken up enough of your time today. I hope this was really helpful and useful to a lot of folks.